The United States just lost a currency war it didn't even know it was fighting. The dollar is collapsing, store shelves are emptying, and the country everyone thought would crumble under pressure? China. It's not just surviving, it's winning. The financial order that once seemed immovable is now cracking at its foundations. For decades, the United States controlled the levers of global commerce with quiet confidence. The dollar was king. American markets set the tempo. And when Washington spoke, the world listened. But, something fundamental has shifted. The balance of power that many assumed would remain firmly in American hands is slipping away. Not through military conflict, but through a financial confrontation that has upended every assumption about economic dominance. China was supposed to bend. That was the plan. U.S. officials, armed with tariffs and threats, demanded that Beijing step back from what they called unfair currency practices. The expectation was clear. China would falter, the yuan would weaken, and American industry would roar back to life. Instead, the opposite happened. The yuan stood strong, the dollar stumbled, and the ripple effects are now tearing through the global economy with a force that, honestly, few anticipated. The consequences are being felt far beyond trading floors. Across the United States, manufacturers are grappling with a reality they didn't prepare for. The tariffs that were supposed to protect them have instead become a burden. Supply chains, already fragile from years of pandemic-era disruptions, are now buckling under the weight of policy miscalculations. Goods that once flowed steadily from Chinese ports to American warehouses have slowed to a trickle. Shipments have dropped by approximately 60%, a collapse so dramatic that it signals something more profound than a temporary disruption. This is a structural reconfiguration of global trade. Retailers are sounding the alarm. Major chains that rely on consistent inventory flows are now facing shortages that could leave shelves bare within weeks. The products Americans take for granted, electronics, furniture, household goods, are becoming harder to source and vastly more expensive. Prices for electronics have surged by over 30%. Furniture costs have climbed even steeper. Inflation, which policymakers claimed was under control, is spiking again. And this time, it's being driven not by demand, but by a supply crisis rooted in strategic failure. Inside the corridors of power in Washington, there's a growing sense of urgency. But, urgency without direction is just noise. Calls are being made for allies to distance themselves from China. Pressure campaigns are intensifying. Yet the coherent strategy that should accompany such efforts remains elusive. The United States is reacting, not leading. And in a contest where patience and planning matter more than volume, that distinction is proving costly. China, by contrast, is moving with precision. There's no panic in Beijing, no frantic policy reversals. Instead, Chinese officials are executing a playbook they've been refining for years. While the dollar weakens and American policymakers scramble, China has injected over $1.5 trillion into its economy, not as a desperate measure, but as a calculated intervention designed to stabilize domestic demand, protect export momentum, and reinforce its position at the center of global trade networks. The yuan has barely moved. That's not an accident. It's the result of strict control over China's financial system and a deep understanding of how to navigate turbulence without losing ground. Beijing isn't trying to win headlines. It's trying to win the long game. And right now, it's succeeding. The American strategy was built on a simple premise. Weaken the dollar, and domestic production will revive. Cheaper currency would make American exports more competitive. Foreign goods would become more expensive. And over time, factories would return, jobs would follow, and the country would regain its industrial edge. It was an appealing vision. It was also deeply flawed. What actually happened was far more damaging. A weaker dollar didn't spark a manufacturing renaissance. It amplified chaos. Because despite years of rhetoric about reducing dependence on China, the reality is that American supply chains still rely heavily on Chinese inputs. components, materials, raw goods, they're still coming from the same place. And with tariffs blocking alternatives and the dollar losing value, costs have exploded. Tariffs that were supposed to punish China are now punishing American consumers. Duties on certain goods have exceeded 100%, pushing prices to levels that make everyday items unaffordable for millions. The strategy was supposed to bring China to its knees. Instead, it's brought American households to the breaking point. Federal Reserve data paints a grim picture. Factory output is declining. Capacity utilization, a key measure of industrial health, is falling. Job openings in manufacturing have dropped sharply compared to the previous year. The workforce itself is shrinking, not growing. And all of this is happening while material costs continue to climb. The promise of a reborn American industrial base now feels less like policy and more like fantasy. One prominent economist didn't mince words. This isn't strategic currency management anymore, they said. This is monetary breakdown. The mechanisms that were supposed to protect the economy are malfunctioning, and with each passing week, the damage deepens. China, meanwhile, is consolidating power. Its central bank has used the dollar's weakness not as a crisis, but as an opportunity. By keeping the yuan stable within a carefully managed range, Beijing has shielded its economy from external shocks while maintaining the competitiveness of its exports. Liquidity remains strong. Growth continues. Trade surpluses are expanding. This isn't defensive positioning. This is dominance, and it's not just about economics. It's about perception. While the United States projects instability and uncertainty, China projects control. That contrast matters. In a world where confidence shapes markets as much as fundamentals do, the narrative is shifting. The country that was supposed to be vulnerable is proving resilient. The country that was supposed to be unshakable is showing cracks. Caught in the middle of this confrontation is Britain. London is facing intense pressure from Washington to sever economic ties with China. The message is clear: choose a side. But the decision isn't as simple as American officials seem to believe. China is a major trading partner for the United Kingdom. It supplies a significant share of British imports and remains a critical market for UK exports. Sectors like electric vehicles, advanced manufacturing, and pharmaceuticals are deeply intertwined with Chinese supply chains and technology. Cutting those links wouldn't just be inconvenient, it would be economically devastating. Rachel Reeves, Britain's Chancellor of the Exchequer, has been blunt about this reality. Severing ties with China, she's argued, would amount to deliberate self-harm. At a time when the UK is grappling with weak productivity growth and a widening trade deficit, shutting out one of the world's largest economies makes no sense. The numbers back her up. In 2023, trade between the UK and China reached over £62 billion, representing nearly 7% of Britain's total goods exchange. That's not a relationship you walk away from lightly. Yet the pressure from Washington continues to mount. Peter Navarro, a prominent voice in U.S. trade policy, publicly accused Britain of capitulating to Beijing. In a sharply worded column published in The Telegraph, he painted the UK as submissive to communist China, language designed to provoke and shame. But behind the rhetoric lies a more nuanced truth. Traditional alliances are fraying, national interests are diverging, and the era of automatic compliance with American demands is coming to an end. Britain is not backing down. Instead, it's recalibrating. Rather than follow the U.S. lead, London is quietly encouraging Chinese investment. It's even considering hosting a Shanghai-based initial public offering on the London Stock Exchange, a move that would signal openness to Chinese capital at precisely the moment Washington is demanding the opposite. A leaked cabinet document reported by The Guardian revealed growing concern within the British government about America's aggressive use of tariffs. One senior advisor reportedly described the approach as economically reckless. That's not the language of a loyal ally falling in line. It's the language of a country reassessing its priorities. Navarro's warnings have grown louder. In a recent speech, he claimed that if China could no longer exploit the United States, it would turn its attention to draining Britain instead. but the data doesn't support that narrative. According to the Rhodium Group, Chinese foreign direct investment into the UK actually fell by 27% in 2024. At the same time, British authorities have tightened safeguards, blocking Chinese involvement in sensitive infrastructure projects. The exclusion of Huawei from the UK's 5G network, guided by MI5, is one high-profile example. This isn't capitulation, it's calculation. Fiona Hill, a former advisor to the US National Security Council, has argued that Britain's moves reflect strategic judgment, not weakness. The real danger, she warns, is confusing dramatic rhetoric with actual policy. From London's perspective, trade is a tool for leverage and dialogue, not a weapon of war. Both Washington and Beijing are under strain. In the United States, GDP contracted by 0.3% in the first quarter of 2025. Real wages fell by 1.1%. Britain, too, is facing challenges. Youth unemployment stands at 5.3%, and housing construction has dropped by 22%. In this environment, trade policy is no longer just about economics. It's about national endurance. Every decision carries domestic political consequences. Every public statement is shaped by the need to balance foreign strategy with internal stability. Dr. Yunwen Sun of the Australian Centre on China and the World describes this dynamic as a two-level game. Leaders are managing international standoffs while simultaneously maintaining credibility at home. Donald Trump promotes a narrative of industrial revival. Rachel Reeves emphasizes multipolar strength and long-term resilience. Neither can afford to be seen as backing down. Despite public statements about openness to dialogue, neither China nor the United States wants to make the first move. Beijing says it's reviewing options. The U.S. Treasury claims negotiations remain possible. But beneath these formal assurances lies a deliberate strategy of ambiguity. A tactic reminiscent of Cold War diplomacy, where uncertainty itself becomes leverage. A social media post from an account linked to China Central Television suggested that the United States now holds the weaker hand. Even so, Treasury Secretary Scott Bessent has hinted that a significant agreement could still materialize if China signals readiness. This uncertainty isn't accidental. It's central to how both sides are playing the game. Financial markets are already responding. By April 2025, net short positions against the U.S. dollar had climbed to over $17 billion, nearly double the levels seen in January. Bloomberg's dollar index has fallen almost 10% since the start of the year, weighed down by widening trade imbalances, unpredictable policy signals, and declining import volumes. Meanwhile, the yield gap between U.S. government bonds and Chinese debt has narrowed to levels not seen since 2006, reducing the appeal of American assets for global investors. As Morgan Stanley's Ruchir Sharma observes, this conflict has moved beyond tariffs. The dollar itself is now on the front line of the struggle for industrial dominance, and that's a battle the United States cannot afford to lose. While America grapples with internal volatility, China is pursuing a quieter, more disciplined strategy. It's carefully managing the yuan's movements. It's injecting massive stimulus without provoking capital flight. And it's reinforcing the foundations of its economy with precision and patience. The contrast couldn't be sharper. One superpower is reactive, scrambling to contain damage. The other is methodical, building strength for the long haul. And in a contest where time, planning, and economic resilience matter more than bluster, that difference is decisive. The world is watching a historic shift unfold. The United States entered this confrontation believing it held all the cards. But the rules of the game have changed. Economic power is no longer measured solely by military might or past dominance. It's measured by adaptability, discipline, and the ability to withstand pressure without breaking. China has demonstrated all three. America is still searching for a coherent response. And as the dollar weakens, the shelves empty, and the cracks widen, one question looms larger than ever. What happens when the superpower everyone relied on can no longer lead?